Welcome back to the Perfect Quest podcast, your guide to a better journey. Today we're diving deep into the latest developments in the U.S.-China trade situation. You shared a stack of sources, and we've sifted through them to bring you the crucial insights. Forget overwhelming headlines. Our mission is to unpack what this all means for you, from the nitty-gritty of the recent tariff adjustments to the broader global ripples. Let's embark on this quest for clarity.
Okay, so the big news, the thing everyone's talking about, is this recent agreement. It came out of Geneva. Looks like a significant de-escalation in the U.S.-China trade war, at least for now.
De-escalation, right. The headlines mentioned lower tariffs. Pretty substantial drops, actually.
Yeah, very substantial. The U.S. is set to lower tariffs on Chinese goods from, believe it or not, 145% down to 30%.
Wow, 145 down to 30. That's huge. In China.
China's responding too. They're reducing tariffs on U.S. goods from 125% down to just 10%. So a big step from both sides.
But I gather this isn't quite the end of the story. Is it all locked in?
Well, that's the crucial detail. It's a temporary measure. They've basically agreed to this truce for the next 90 days while talks continue. And importantly, some tariffs are just suspended, not completely canceled.
Suspended, meaning they could potentially come back.
Exactly. If progress isn't made in these ongoing talks, those tariffs could snap right back into place. Plus, it's worth remembering, those pre-existing tariffs, the ones on specific sectors like steel and cars, that they're still active.
Okay, so the old ones remain.
Right. But on the positive side, those additional retaliatory tariffs, the ones added later in the tit for tat, both sides have agreed to cancel those entirely. That's a pretty clear signal they want to cool things down.
And it wasn't just about tariffs on goods, was it? There were other sort of non-tariff barriers involved.
Spot on. China has also agreed to, and the wording is suspend or remove, all non-tariff measures against the U.S. Think about things like restrictions on critical mineral exports. That's a big deal.
Okay. But is it a complete reset?
Yeah.
Any exceptions?
Well, there is one interesting point. The U.S. is actually keeping an extra 20% tariff on Chinese goods. And the stated reason is specifically to pressure Beijing on the illegal fentanyl trade. So you see this overall de-escalation, but certain specific leverage points are being maintained.
Okay, so that's the current situation. Let's maybe rewind a bit. What was the original thinking behind putting these tariffs in place? It feels like we've been on this path for a while.
Yeah, good question. If you look back at the rationale from the U.S. administration, under President Trump initially, there were several stated goals. One was definitely about putting pressure on foreign governments, not just China, regarding their trade practices, but also things like immigration and industrial policy.
And the trade deficit, right, that was mentioned a lot.
Oh, absolutely. Addressing the U.S. trade deficit, particularly the large one with China, was a major justification. And another key aspect was protecting U.S. industries from what was framed as unfair foreign competition.
Using tariffs as a tool, basically.
Exactly. President Trump often spoke about using them as a negotiating lever, using the sheer size of the U.S. market as, a bargaining chip. It's kind of interesting. Historically, tariffs used to be a major source of U.S. government revenue, like way back from 1798 to 1913.
Really? I didn't know that.
Yeah. But then, for decades more recently, the U.S. generally moved towards trade liberalization, working through agreements like GATT and then the WTO. The whole idea was fewer barriers, more predictable rules.
So this recent period marks a pretty significant shift away from that trend.
You could definitely say that. It signals a potential return to using tariffs much more actively as a direct policy instrument, rather than relying solely on those multilateral frameworks.
Okay, so tariffs go up, markets get shaky, then tariffs come down a bit, markets rally. What does all this back and forth actually mean for, the average American, for you listening? How does it hit the wallet?
Right. This is the crucial connection for most people. The general economic principle is that when tariffs are imposed on imported goods, it increases the cost for the companies bringing them in. And, businesses often pass at least some of that increased cost onto consumers, so you could expect prices for everyday items to go up.
And that impact isn't spread evenly across the board, is it?
No, definitely not. Many experts point out that lower-income families are likely to feel the strain more acutely. Think about necessities like food and energy. These items typically make up a larger percentage of their household budget, so any price increase there is felt more significantly.
So it acts kind of like a regressive tax, hitting lower earners harder proportionally?
Precisely. That's the term economists often use, a regressive tax. A small price hike on, say, groceries might be annoying for a higher income household, but it can be a real budget breaker for someone on a tighter income. And it's not just about prices at the checkout. businesses facing these higher costs might see their profits squeezed.
Which could lead to what? Job cuts, slower wage growth.
Potentially, yes. Or they might shift supply chains, which also has knock-on effects. Sectors that rely heavily on imports are obviously the most exposed. We're talking about the automotive industry. Lots of parts come from Mexico and Canada. The energy sector, with crude oil imports. Even the food we eat, many fresh vegetables and fruits come from Mexico, for example.
So specific examples, what kind of things might get more expensive?
Well, the list could be long. Groceries, electronics, clothes, shoes, even getting your car repaired if it needs imported parts. There were some pretty stark estimates floating around. One suggested that recent tariff policies could cost low-income households something like $980 a year.
Nearly $1,000, wow.
Yeah, and specific projections like apparel prices potentially jumping 17%, or new taxes on building materials adding thousands, maybe over $9,000 to the average cost of a new home.
That's significant. And what about bringing production back home? Doesn't that solve it?
It's much more complex than it sounds. Rerouting entire supply chains takes years, huge investment. And even then, for some goods, think bananas, coffee domestic production just isn't feasible at the same scale or cost. So you might still see inflation for those items.
And we might see more of that shrinkflation too, less product for the same price.
Very likely, yeah. It's a less obvious way for companies to manage rising costs without raising the sticker price quite as much. Consumers are definitely getting savvy to it, though.
Okay, so real impacts on household budgets. What about the financial markets? All this tariff talk must have made them pretty jumpy.
Oh, absolutely. Volatility has been a key feature. Whenever there were announcements about new tariffs, especially those initial reciprocal ones, you often saw sharp drops in share prices. Interestingly, sectors with high valuations, often tech stocks or consumer discretionary companies, the ones selling non-essential goods and services, seemed particularly sensitive.
Why is that?
Well, part of it is just general uncertainty. When trade policy is unpredictable, businesses tend to hold back on big investments. They wait to see how things shape out. And less investment can mean slower economic growth overall, which makes markets nervous.
But didn't the markets react pretty well to this recent news, the de-escalation?
They did, yeah. Quite positively. When the news broke about the temporary tariff reductions, we saw a significant jump in the major U.S. indexes, the S&P 500, the Dow, the NASDAQ. They recovered a good chunk of their earlier losses.
Which company saw gains?
You saw big names, especially those reliant on consumer spending or global supply chains, doing well. Think Target, Home Depot, Nike. Also, tech giants like Nvidia, Amazon, Apple, Meta. They all rose sharply. Even shipping companies got a boost, presumably on the expectation of, more goods moving back and forth again.
And what about things like gold, the safe havens?
That's another interesting indicator. Gold prices actually fell after the tariff reduction announcement. Since gold is often seen as a safe place to park money during uncertainty, a drop suggests investors felt a bit less worried, a bit more optimistic about the immediate economic outlook.
Okay, so it's clear this isn't just a U.S.-China issue. This whole situation must be sending ripples across the entire globe, right?
Yeah.
Affecting lots of other countries.
You're absolutely spot on. The implications are definitely global. This latest pause, this suspension of tariffs, it creates this sort of interesting dynamic. It might incentivize or put pressure on third countries to kind of choose sides or align themselves more clearly in trade arrangements.
So other countries are getting pulled into negotiations.
Exactly. We're seeing the U.S. engaged in active trade talks with a whole range of partners. The UK, India, Japan, Canada, Mexico, the EU, they're all trying to navigate the shifting landscape. And at the same time, China is also busy strengthening its own economic ties, particularly with the BRICS economies, Brazil, Russia, India, South Africa.
It sounds like the whole structure of global trade might be changing. Less reliance on the big international rules.
That seems to be the trend, yes. A move towards a more bilaterally managed system. Deals struck directly between two countries based more on reciprocity, you do this for me, I'll do this for you, rather than strictly following the established multilateral rules of organizations like the WTO.
Is that sustainable? Making deals in a more kind of casual way.
Well, that's one of the concerns some analysts raise. Agreements made perhaps without formal treaties or legislative backing might be less stable in the long run. They could be changed more easily depending on political winds.
And what about the overall volume of trade?
That's a big question mark. The potential is there for reduced global trade volumes, especially shipments heading to the U.S., given their stated goal of cutting the trade deficit. Now, if trade among other countries doesn't increase enough to compensate, then yeah, A decline in overall global trade could definitely put a damper on global growth prospects.
So less U.S.-China direct trade, maybe?
Quite possibly less direct trade, but it's also possible that indirect exports could be more resilient. Chinese products potentially finding their way to the U.S. market via third countries. Supply chains might just get longer and more complex.
Which other regions might be particularly affected?
Southeast Asian economies could be heavily impacted by U.S. tariffs, given their integration into regional supply chains. The EU as well. And, of course, any country hit by U.S. tariffs might impose retaliatory tariffs of their own.
Which just hurts U.S. exporters and escalates things again.
Exactly, it creates this cycle. And the sheer unpredictability, even with the current pause, probably continues to serve one of the U.S. objectives, which seems to be reducing its economic dependence on China specifically. So, the overall picture, according to many analyses, is that these tariffs, even with temporary suspensions, could lead to net global welfare losses and a significant fall in trade. Supply chains are almost certainly going to shift, potentially becoming less efficient, maybe less transparent. For investors, it means navigating challenges but also potential opportunities, with a real need to focus on long-term fundamentals and diversification.
So as you can see, this deep dive into the latest U.S.-China trade news reveals a really complex and rapidly evolving situation. It has far-reaching implications, from the tangible effects on your wallet, the prices you pay, to this broader reshaping of global trade. The temporary tariff reductions offer a moment of de-escalation. But well, significant uncertainties definitely remain on this journey. We hope this has provided you with a clearer understanding of the key takeaways. What stands out to you most from this analysis? What further questions does this raise about the future of global trade and its impact on our daily lives?
That's it for today's chapter. This was the Perfect Quest podcast. See you on the next journey.